Hello, everyone. This is Mark and Bruce, and we are the Value Trap podcast. This week, we're talking about banks, cyclical stocks like Somero and Sylvania Platinum, Arcontech, WANdisco, and much, much more.
Welcome to the Value Trap podcast. I'm Mark Simpson. So I view myself primarily as a deep value investor. I like to pick what other people don't and what other people hate, hoping that I'm getting a bargain. A few years ago, I wrote a book called Excellent Investing. Really is a focus on how you do the process of portfolio management better. Stock picking is probably about 50% of the work of being a successful investor, and the other 50% is avoiding behavioral biases and better portfolio management. So hopefully, various points on this podcast will talk about all of those and more topics. Bruce, what about yourself?
I'm Bruce Packard. I write for Money Week and ShareScope. Before that, I used to work at Credit Suisse and SocGen and various stockbrokers and banks in London. I'd probably describe myself as, I started off as a value investor, probably more of a quality investor now. I like to buy and hold. I don't like to buy things at a huge discount and then sell them when they go up 20%. I'd rather look for things that are going to go up by 5 or 10 times.
I reckon that's a good place to start with your kind of banking background, because the big news this week has been that Silicon Valley Bank put into insolvency and now appears to have been bailed out, for want of a better word. Plus the UK part was bought for £1 by HSBC. So Bruce, do you want to take us through your view of that?
First of all, when you say bailed out, the equity investors have lost everything. The management have been fired, although actually there are some stories that some insiders were selling a couple of weeks ago. They might have been able to walk away with some of the cash, but the deposit holders aren't going to lose money. And that's the important thing. So I think when you look at the screens and your banks being sold off at the moment, is that because equity investors are suddenly panicking about the equity value of Credit Suisse? Or is it because investors are suddenly worried that Credit Suisse, which has a $500 billion balance sheet, are people now beginning to worry that Credit Suisse might be in trouble and there's counterparty risk there?
For Silicon Valley, it was depositors removing their cash that precipitated this, wasn't it?
Yes, an extraordinary level of deposit outflows. The balance sheet was a couple of $100 billion, and they sourced $40 billion in the weeks before it collapsed. So everyone was just rushing to take their money out. There are a couple of specific things to Silicon Valley Bank. One of them was that 90% or over 90% of the deposit holders were uninsured. In the US, they have a $250,000 limit. So because it had a lot of corporate clients, people were perhaps right to worry because they weren't going to be covered by the government deposit insurance. And that's not the case of the likes of HSBC or Lloyds or any Standard Chartered Bank. Any of these banks, they have a lot more sticky retail deposit holders. I suppose the other thing to be aware of is that these guys seem to have really messed up their risk management with buying lots and lots of long-dated securities with 10-year maturities. And of course, as interest rates rose, those declined in value. You could see that in the bank's balance sheet, though, in the notes of the accounts, that they did say what the mark-to-market losses would be given the interest rate movements. So it was all there hiding in plain sight.
They could get away with not declaring that apart from the notes, because you can say, I'm going to hold these things to maturity, and then you don't necessarily mark those losses, which makes sense on one level, but it seems that they were playing this game of having mismatched duration much more than a lot of these other banks.
Yeah, I think that's right. And to be clear, the accounting profession really struggles with how to account for banks. All banks, the loan book will be on a historic cost basis. But the securities that they hold on to, whether that's CDOs or CDSs or government bonds, a lot of that will be in the available for sale portfolio, which has to be marked to market. But there's also hold to maturity portfolio, which theoretically you can hold them to maturity and that's not a hit to equity. But of course, we know there was 18 trillion of negative yielding debt at the end of 2021, and someone's holding on to that. And that 18 trillion of negative yielding debt a couple of years ago, with interest rates rising, with inflation hitting double-digit rates, that's probably not worth 18 trillion anymore. Someone is holding on to some losing positions, and whether it's mark to market or whether it's historic cost accounting, that doesn't change the underlying economics of the fact that rising interest rates reduce the value of long-dated assets.
And do you have any idea of where these skeletons may be hiding, or is it throughout the system?
With a number that size, I think it's throughout the system. But the one place I'm keeping an eye on is the Japanese banks, which sold off and continued to sell off at the start of this week. No one seems to be talking about them at the moment, but we know that the Japanese central bank has been doing a lot of quantitative easing and has kept going with quantitative easing while everyone else has been quantitative tightening. And when I last looked at the Japanese bank balance sheets, it didn't tend to be loans. They did tend to own a lot of government securities.
One to watch, I guess, for that has a kind of systemic impact. It feels like the UK small caps, the kind of mid cap companies we track, probably shouldn't really be massively affected by this event. So do you see this as a bit of a buying opportunity? What's your thoughts on the sell-off that's happened in response to this?
It very much depends on whether this is systemic. And my initial reaction was, this is one US bank that has got its risk management horribly wrong. The market reaction is rather surprisingly with all these global banks selling off. Potentially what it means is that the interest rate cycle, interest rates are going to peak at a lower rate, or at least the central banks are going to pause for breath and see if anything else breaks. That ought to be good news for small caps, that you could either keep your money in a bank earning very little and interest rates aren't going to rise and inflation is going to stay high, or you can put your money to work in the equities market. And it feels the equities market, over the long term, equities tend to do better than cash held in the bank.
I think this idea that higher interest rates are terrible for equities is a fairly new phenomenon. I think these things go through trends and cycles over a number of years. It used to be the prevailing view that, oh, actually, equities are the best inflation hedge, so you should hold them. But then in the 70s, equities sold off. It wasn't that view. And I think people forget that ultra low interest rates are usually a symptom of malaise in the economy. Yeah. So actually those earnings on aggregate of all those companies are not growing particularly quickly. So this idea that you should then bid them up to high multiples because interest rates are low and the net present value is lower, it seems a little bit daft to me.
I think I'm right in saying that Japanese interest rates in the 1990s, when the peak of the bubble, were 5%. There was this curious statistic about the piece of land in the center of Tokyo was worth more than the entire state of California. And then we've had interest rates in Japan at very low levels for a couple of decades, and the equity market has failed to perform. So I think there's a lot more that goes into equity returns than just trying to guess what the level of interest rates are.
And I think for us that invest in kind of smaller companies, you have to consider that the kind of interest-free rate is only a very small amount of the cost of capital to those businesses. The risk part of it, when you're investing in something that's a less than 100 million market cap, you really should be looking at, say, a minimum of like 15%, if not 20% cost of capital. Or cost of equity, at least. I guess the debt part can be a bit lower. So therefore, if it's all equity financed and interest rates go from 3% to 0, it's like your discount rate going from 18% to 15%. It's not as clear cut as such a large reduction in interest rates means such a large increase in the value of equities.
Yeah, and the other thing to point out, maybe we'll move it on to more stock-specific discussion. There are quite a few stocks on AIM that are on less than 10 times earnings, that hold a lot of cash and report very high historic returns on capital employed. I can think of a few like Somero, which is on 8 times earnings, return on capital of 50%, and cash of 34 million. Sylvania, the platinum miner, is on 5 times, return on capital of 30%, and cash of 124 million. That's almost 40% of its balance sheet. Sorry, 40% of its cash is its market cap. And also Tharisa, another South African mining company, again, 3 times earnings. There's a reason why these things are trading on low PEs, which is that they're cyclical and the market doesn't quite believe they're going to achieve their earnings estimates. But even if the stock is on 5 times earnings and earnings halve, you would expect the share price to go down, but then it's on 10 times earnings, which still seems a reasonable bargain.
Yeah, Sylvania is one I've looked at in detail in the past and I've held in the past. I don't hold at the moment. I get that argument that the market is pricing the unsustainability of these commodities, in this case with Sylvania. For a while, those commodities haven't actually reduced, but you look at rhodium, for example, this year, and it's sold off from about sort of $1,300 to about $9,000 an ounce. Still historically relatively high, but I feed that into my model for Sylvania Platinum, and it won't necessarily hit this fiscal year because you've only got effectively Q4 to go. But next year they could perform operationally the same and earnings could halve. To me, it feels a little naive to think that the market isn't going to react to that, particularly because brokers' forecasts have earnings rising. And actually, if the result is that earnings halve...
If earnings halve, the share price tends to go down. Yeah, there's an old rule of thumb that says you should never buy cyclical companies on low PE multiples because actually the E is wrong. House builders might be another example. And what you do best when you buy cyclicals when they look incredibly expensive because they're not making any money. I understand that argument, and I can't bring myself to sell a stock on 5 times earnings.
Maybe 10 times forward earnings.
Yes, maybe 10 times.
Yeah.
But, you know,
still a cheap rate. EV to free cash flow, the EV to EBITDA on that kind of stock is probably still at 3 or 4, not particularly expensive. But I bought it when it was on an EV to free cash flow of 1, and probably sold when it was on an EV to free cash of 2 because it had doubled. There is an aspect of this is a pretty risky South African mining stock and is never going to be is never going to have a EV to EBITDA of 15, for example. Absolutely. And the other part of that kind of EV, once you start to include the EV, you have to say, what are they going to do with the cash? So what's your thoughts on that?
Yeah, funnily enough, I'm not really worried about earnings going down next year. What worries me is the story has changed. So for people who don't know it, Sylvania isn't really a platinum miner. What they do is they have a chrome tailings business, a process that converts salmon cores, which is a chrome mining tailings, the waste product from minings. And what they do is they can find the platinum in that waste product from the other mining company. They spent 10 years building all the equipment and plant and machinery to do this. Now what they're talking about, although they've got long-term contracts with the company, there is a finite life to that. And they're now talking about using some of that cash to develop real platinum mines, dig the stuff out of the ground, as it were. Forgive my South African pronunciation. One of them's Northern Limb, one of them's Volspruit. And the risk reward of that is much higher. That if you've got a tailings process which takes the waste product of another miner and you know it works, then all your risk is really in the platinum price. And Sylvania historically has been in the bottom quartile of the lowest cost platinum miners. Some of these high cost platinum miners, Lonro, went bust actually, had to be rescued by the South African pension authorities because they had expensive mines and it was too expensive for them to dig the stuff out of the ground. Whereas this wasn't the risk for Sylvania, but now it's turning itself into a platinum miner. Another problem investors have with how do you value cash on the balance sheet? If that cash is going to be redeployed and it's going to be well invested, then that cash is incredibly valuable. And if they can achieve a 30% return on capital of that $124 million of cash, then that's fantastic. But if they can't, if they're going to waste it on mines and they're not going to be able to dig the stuff out of the ground in a cost-effective way, then that cash isn't going to go to shareholders. So that's the thing that worries me.
It's definitely a kind of a change in strategy, isn't it? They probably want to joint venture, or they don't really want to be getting into this mining. But I think because it was originally called Sylvania Dumps, and it used to be these dumps of Sanam's tailings, and they're working their way through those, and they do have what they call fresh arisings or run-of-mill kind of stuff. So that's the stuff that's coming out of the plant today, but they can't produce at the current sort of 72,000 ounces target just from what's coming out of Sanam core today. So they're working there through the dumps, and maybe they could buy more dumps from somewhere as well. It's a kind of quite a strong strategy in South African mining. You see something like DRD Gold that is almost completely producing gold from these historic piles of tailings. It's a good business. They don't have to crush it. They don't have to spend a lot of energy, and they can put very low grade material through modern processes and come up with production. So it is a good business model. And your feeling is that they'd love to continue doing that, really, but nobody else seems to want these new mines. And maybe there's a bit of sunk cost fallacy. If they've put money in, they know there's resources there and they're going to go alone because nobody else will put the cash in or is willing to take the risk.
Just going to come back to your thing about the production. I couldn't find this in the words of their H1 statement. They've got a June year end, so their H1 was July to December last year. I couldn't find this in the text, but what they did do is put up an ounce production graphic in the presentation, which did forecast the production from 2023 to 2025 rising from 70,000 ounces towards 80,000 ounces. So in the short term, it looks like going to be fine over the next couple of years, but they're obviously thinking a bit further ahead in terms of these chrome tailings that are going to run out at some point.
And ending life of mine is often a real worry for market participants. I've got shares in a company called Base Resources that produces heavy mineral sands in Kenya, and it's highly profitable at the moment at current prices. It's got this kind of cliff edge where probably towards the end of 2024, mid 2025, unless they find new resources in Kenya, their production's kind of ending. And they've got a new project in Madagascar that's being delayed by various politics. They've paid out a big dividend. They'll earn more cash from Kenya than their current market cap until the wind's down. But again, the market has two fears. One is that Shell isn't going to see that cash. And that's a world-class project. That's not a small project. It's a world-class production project. But if there's a gap, if there's no production, the market really doesn't like that and really fears that end of life at any mining company.
Absolutely, yeah. I agree. We should probably move on from mining stocks. Otherwise, people will think that we're a mining podcast. Talking about lots of South African or African mining companies. One of the ironies there, of course, is I've said I'm a quality investor and you've said you're a value investor, but I'm the one that owns Sylvania and I may be the one that's being value trapped.
I own a small amount of Tharisa, which is their sort of does the chrome mining as well, so chrome and PGMs, and I haven't yet done the detailed work to build models in the same way as Sylvania, so I'm potentially falling for exactly the same risks that you have fallen for. But
I've paid 5 times. Sylvania's on 5 times earnings. Tharisa is on 3 times earnings. So there you are. You're a true value investor.
Yes, so I've got the comparatively deep value play on that one. Yeah. So should we talk about like other companies that have this kind of large cash balance? I think one that we both had come across was Arcontech that had results a couple of weeks ago.
So what Arcontech do is they're not a data provider. They're not like Bloomberg or Reuters, Icon or any of these things. But what they do is they allow banks and central banks to bring together their data and their markets data all in one place. And they manage that process of Excel spreadsheet add-ins. And I looked at this a couple of years ago. It's incredibly profitable because it's a software company that's they've put the sunk cost in. They've got something that clients like, but they're struggling to grow at the moment. And the last couple of years, they've hired a sales force, partly because of the pandemic, but partly because I wonder if something else is going on and they're struggling to persuade clients that this is worth paying for. I don't know what your thoughts are.
I've seen opposing views that this is really valuable technology. That's, look at their client list, Bank of England, JP Morgan. It's like what you'd want as a client list in this sector. Yeah, I also can't help thinking that Excel add-ins is not a great competitive advantage that somebody like Bloomberg could.
But Bloomberg already do an Excel add-in for Bloomberg.
Yeah.
I guess it's to do with the fact that you can bring together disparate sources of information into the same place. There are also API calls that you can make that you can get data from. Essentially, you just call the data into your program. And that seems to me an efficient way of doing things as well. I'm not quite sure I understand the technology. Even though I worked in equity research, I feel like this is something that's very specialist. The thing that slightly worries me is that if they've hired the sales force and it's not growing, it does make me wonder if it will suddenly become completely obsolete.
Yeah, it might be the same with the life of mine. It's effectively, it's got a limited life of mine and it's going to drop off as other technologies, just more database end connections. Again, I'm not a technical person on this, but I also recognize that my history, effectively internal consulting type stuff for big firms, was a lot of the pain points and the stuff we did was merging data sources together. And it was always expensive and it was always challenging to get that stuff done between usually legacy systems that have been in place across different firms, particularly acquisitive companies that have taken on lots of different companies over the years, and then they get the quote to put in the new system and it's suddenly hundreds of millions of pounds, and that doesn't happen. So you live with these sort of APIs for quite a long time often.
I mean, one thing I did do is I went back and looked at what the revenue growth did through the financial crisis, and they did grow revenue for 2008 2008 to 2009, which I took as a good sign. But obviously it's quite small, so whether that's representative, I don't know. The other difficulty is management don't get out there and present. They haven't been on things like Mello, they haven't been on Investor Meet Company. And so it does feel like perhaps they don't have a good story to tell at the moment, which is understandable. They've hired the sales force and they want to make the sales. So that's something else that puts me off a little bit. And I can understand as well, people might be worried that banks, Credit Suisse share price off 15% yesterday. People think there's a banking crisis going on. Banks have probably got other priorities than spending money on their data. But even then, they do seem to have some central bank customers. So you would expect the central banks, that shouldn't be an impact for the central banks. They ought to be paying up for this sort of thing if it really is valuable.
The other thing that really puts me off is because I'm as a value investor, I'm attracted to something on a free cash flow yield of 10% that's in the software sector with what appears to be sticky client. All the SaaS stuff's talking about 3% free cash flow yields and things like that. But to get that calculation, you have to put value on the cash that's in there. And they keep generating cash, it keeps piling up, and they keep saying that they're looking for opportunities, but 5 million or whatever that they have doesn't buy a lot in financial services. They're quite specific about what they'd want, I think. And they've been trying this for at least 4 years, from what I can tell, if not longer. And they've not found anything. Sooner or later, it's got to be return that cash. But then you've returned the cash. It's such a small company. Why would you have it listed?
So this is one that you don't own then?
I don't own, no. I've looked at several times. Yeah, the metrics on the surface look pretty good. But I struggle with what are they going to do with that cash? Is it going to be value added? And we know that often, particularly with management with no history of quality acquisitions, the acquisitions are value decreasing rather than enhancing.
Again, so this might be another one where I'm value trapped, that it looks attractive on a superficial level, whether I'm missing something. I did think that this looked attractive and it made sense. I'm now having second thoughts. But you've got some ideas about small cap tips.
This links quite nicely to a theme that I've been seeing in the markets this year, is that it does feel like smaller investors who've still got a massive level of uncertainty in the market, and it's just ramped up in the last couple of weeks. It seems that the thing that moves the market these days is tips, and they can come from two sources. One is people follow an influential investor who's well known into a stock and almost think they're shortcutting the research required by following this person in, and the other one is like literal tips. So I think Arcontech, when it had results last week or the week before, initially sold off. When people had seen the results, the initial reaction was sell the stock, and then I believe the Investors Chronicle picked it up a day later and said, oh no, actually these look good value and potential takeover target, and the shares went up above the level they were before the potentially poor results. Just seems that this is just a very risky strategy, buying these things on tips. What's your thought?
Absolutely. The one thing that I'd be very keen to do is I might share ideas and say what I own, but I would encourage people to do their own thinking. I would also say that when you listen to what fund managers own, a lot of things I've found that do very well are things that haven't gone anywhere for a few years. Off the top of my head, I can think of Impacts fell from about 70p to about 40p over the course of 5 years. And then it started seeing inflows and something clicked and it did incredibly well. And there are a lot of stocks like that. But when you hear a fund manager talking about, or what stocks do they like, it tends to be stuff that's already done quite well, because they don't want to go on Mello or wherever and say on PI World and say, oh, I own this thing and it's fallen in value for the last 5 years. Its share price is down 60%, but I still really like it and I think it's great. So when you listen to the type of things that are tipped, it tends to be stuff that's already done well. Now, it might continue to do well, but just bear in mind, you're probably not calling the turn. And there's also a chance that something that's done well for the last few years, something else goes wrong and it's not sustainable.
I'm always surprised that the impact, particularly these kind of fund manager interviews, can have on stocks. I remember a kind of PI World one where it seemed like almost like the stocks were moving as people were watching the interview. And it's probably a symptom of the type of markets in 2021. But what I always do is I go onto Trustnet and I look at this guy who's professing expertise in small cap stock picking. How has he performed? And I'm consistently seeing fourth quartile performance over 5 years, people who've lost money for investors over 5 years. fund management's hard, not sort of having a go at these guys and saying they're terrible. They're fighting a losing battle because they can't get in and out stuff when they want. They have to take money in placings. They have to hold stuff. They sometimes hold 100 stocks to get the exposure. It's not an easy game, and it's not necessarily a game I would want to play in that way.
One of the things is you tend to, as a fund manager, you tend to see inflow precisely the wrong time. So there are probably lots of fund managers who saw inflows right at the top of the vaccine rally halfway through 2020, and they were sitting there receiving all this cash going, oh, where do I put it? Where do I put it? I don't know what's happening now, but you certainly saw it in the financial crisis. People saw outflows in Q4 2008 when there are a huge number of bargains around. And you had forced sellers because people were asking for their money back from hedge funds and asset managers. So that is something that, as private investors, as retail investors, you don't have to worry about someone tapping you on the shoulder and saying, yeah, can I have my money back on a day like today?
But with all that thing, I still think there's an aspect of, why would you listen to somebody whose public record is fourth quartile? Why would you place so much weight on it? Yeah, I enjoy listening to these interviews and getting the principles out of them. Really often I find the stock specific stuff, and everybody wants this shortcut. They want the stock specific stuff, but the reality is that's usually the weakest signal to noise in that sort of thing.
I feel like in some ways, if you want to do investing yourself, you have to enjoy the process of reading the first-hand sources, like being a historian. You can read A.J.P. Taylor or whoever on the cause of the First World War, but actually the value is getting all this unstructured information, the first-hand sources, the company announcements, and reading in between the lines, reading the outlook statements, and just trying to figure out who's being over-optimistic and who is being perhaps more realistic, and who's very good at communicating what their challenges are and how they're going to address this, and who is full of hot air saying, yeah, we're wonderful and we have no competition and everything's great.
The one other thing that comes to mind with that is, I remember, I think a guy called Meb Faber, did a hedge fund replication strategy and wrote it up. And he looked at, in the US, all the hedge funds have to publish what their top 10 positions are. And he looked at, can you just follow them into their best ideas? This worked. This generated alpha with one caveat. And that caveat was, you don't invest in the biggest holding, which backs up your view that actually these have got to be the biggest holdings or the conviction positions because they've done well. Market wisdom is that you should always run your winners. And I think that's true. As value investors, we have a tendency to snatch that 20%, snatch that win. But the evidence here is you can run your winners too far. And some of the brightest investors of hedge fund managers tend to run certainly those biggest positions too far. And you're better, like you say, with the one that's done nothing for 3 or 4 years.
Yeah. Should we talk about conviction positions? Bank of Georgia, Georgian banks could be a...
yeah.
I don't know if you've looked at the Georgian banks, but there are a couple of Georgian banks that are listed in London, which I'm partly responsible for, which I talked about in the previous podcast. I won't repeat that. But Bank of Georgia is the one I own, but also TBC Bank. And these have sold off in the last week, not because of the general banking crisis of interest rates rising or credit risk, but there looks to be a little bit of a political crisis going on in Georgia. Because the fascinating background of this is that there's this guy called Bidzina Ivanishvili, who was elected in a fair election in 2012, but is now subsequently, I think it's widely agreed that he has probably some friends in the Kremlin, because no one becomes a billionaire in 1990s Russia without knowing someone who knows something or knows other people who know something. And he tried to pass a foreign agents bill similar to what Putin passed in 2012 to prevent NGOs receiving money. And also, it would also held back independent journalism, for example. And the crowds came onto the street to protest against this, and the government's now changed its mind. But that is slightly worrying from a bank investor perspective, because if you've got a country where the political parties is closely aligned with Russia, all sorts of bad things can go wrong. I would just say also that, but I think this guy is a wealthy billionaire who's got all his money in Credit Suisse, or used to have all his money in Credit Suisse. So he wants to avoid being sanctioned. So I'm not sure how this plays out. But he's obviously got this pressure from Moscow to be a more authoritarian regime and target people that Putin doesn't like within Georgia. But he's also got this problem that the population of Georgia is very pro-Western and thinks the EU is a thoroughly good thing. and wants to sees Europe as the future and Russia as the past. So he's got to balance these two things. Anyway, it's fascinating to watch, but all the Georgian banks were off about 15 or 20% in the last week, which makes them even cheaper, and they're on about 5 times earnings now. Again, an example of, do you buy cyclical stocks when low PEs, or is it better to buy banks when they're on high PEs?
Is there currency risk here? Could it be that all their assets are in a local currency and their liabilities are in dollars? Or
no, so the balance sheets of these banks tend to be about 60% US dollars. So people prefer to save in dollars, but they also borrow in dollars because it's a lower interest rate. But yes, of course, if you're earning money in lari and you have US dollar debt, that can go wrong. So the central bank has been trying to gradually shift people over from saving in dollars to saving in lari. And so far, actually, over the last 10 years, that's worked reasonably well because the lari is actually strengthened. It's one of the few currencies to have strengthened against the dollar in the last couple of years, I think. And certainly it's strengthened against the pound. But there's this general feeling that this is driven by customer demand. Customers want to save in dollars. And so they have all these dollars. The banks have these dollars, so they tend to lend in dollars too. And it's a gradual, slow process. And apparently the country to look at that did this very well is Israel, that they converted their bank balance sheet from US dollars to Israeli shekels. It did take quite a long time to persuade people that they should be saving in the local currency rather than saving in dollars.
Given what's happened with Ukraine, this does feel a little bit high risk for me. But I think as well, this is one of my biases, is I don't really invest in banks because it takes a different skill set to invest in them than your average kind of company. So in some ways, I'm happier with an African miner than I am a UK bank, which maybe you could say there's
I think that's a valid observation. I think before the financial crisis, I can remember hearing someone talking about Google saying this company's only been around for a few years and it's already got the market capitalization of Lloyd's, and Lloyd's is a great bank paying a dividend with a high return on equity of 30%. It's hard to believe, but before the financial crisis, people thought banks were boring, profitable, dividend paying, low growth. And actually that perception was completely wrong. So there's this idea, I think, that there are risky things and kind of safe, dull, boring investments. What you don't want is to buy something that you think is safe, dull and boring, very profitable. And actually it turns out they're running lots of hidden risks that you hadn't appreciated, which was certainly the case of the banks before the financial crisis.
I guess at least this one is risky. That's the reality and you position size accordingly.
Yeah, but very often these things that look risky, I don't know, fund managers would be another example. Fund managers, very hard to analyze because when they see outflows, the economics look horrible. When they see inflows, the economics look great. Those inflows can turn to outflows very quickly when you see some underperformance. But over long term, there are quite a few fund managers that have done very well. I own Impacts, but there are plenty of others. Schroders has done very well. Jupiter actually done terribly. And whether you could look at Jupiter and compare it to Schroders and say, oh yeah, actually Schroders have got a much better business model, or what's the other one? Standard Life would be another example of one that hasn't done very well. So there's a lot of idiosyncratic risk, and it's very hard to identify, other than the inflows, what's driving that.
Yeah, and I think anything that's high risk, I think it's fine to invest in. And I think this is a mistake a lot of people they go either, I will never invest in this, or they're blind to the risks and they put 10, 15, 20% of the portfolio in something that, and I take your point with the banks in 2007, people didn't realize that they were as risky as they were. That's a sort of maybe a hindsight bias of looking back and saying, oh, it was obvious. And it wasn't obvious to me in those days. But I think that's the mistakes people make. I think you can invest in these riskier things if you're willing to have smaller positions and also not go, okay, I've got 2% positions in small cap oilers that are all exposed to the same commodity. That's there's the kind of risks.
Talking about risky things, should we just wrap up the conversation with a few comments on WANdisco?
Yeah, so I had a bit of debate with the guys on Mello last night about this one. For those who don't know, WANdisco was a highly rated stock. It was on something like 100 times sale and seemed to be performing very well, was being awarded these pretty large contracts that, that they said were from top 10 global telecoms businesses, and they'd announced a 25 million contract. And I don't think that was necessarily firm, I can't remember what they call them, but something like almost like an intention to purchase this amount over a certain period. But clearly, talking to these telcos, it turns out at the end of December, they announced a contract that seemed to be planned to be delivered in the last couple of weeks over Christmas, and meant that they were going to exceed expectations, the phrase the market likes. And I don't know whether as part of the audit process or part of just their general due diligence, they found that it appears that those contracts are not valid. And the last statement said that there was a material uncertainty over going concern issues.
Yeah, we don't really know what's happened, because it's one thing to have an order book, and an order book might be a sales pipeline, however you want to call it, is open to subjective judgment. Orders can be cancelled. Investment banks like to talk about a pipeline of IPOs, but those pipeline of IPOs can dry up pretty quickly in market conditions like these. But the statement, the RNS also referred to the cash. You would have thought that the cash was either there or it's not there. And it turns out that it's not there.
Yeah, I didn't spot this in advance, but also on 100 times sales, I wasn't looking. It seemed to me that certainly with my strategy, that the odds were against this.
Really a value investment. Really.
Yeah, no, look at its history. It hadn't exactly set the world alight in the past. And I know things change and kind of companies do sometimes get a bit of momentum behind them, but certainly wasn't visible in the historic numbers that this was going to be a go-go stock. The other aspect was people were already questioning some of the revenue recognition. I think receivables looked like they'd increased more than booked revenue for some periods. Do you think it's something people could have spotted?
Yeah, I agree that the 100 times sales meant that I didn't look very closely at it. One of the other things that I worried about was it seemed to be doing stuff with cloud computing. If you're competing against Amazon, Microsoft, and Google, however good your technology, you just felt that wasn't a space that I was particularly interested in, because I felt that was going to be a scale business which the big US tech companies would win. They seemed to say they were doing something special and they weren't a direct competitor with those bigger players, but I was less sure than that. So that's the other reason I avoided it.
A lot of companies that go on to have problems, revenue recognition is behind a lot of them. And software is one area that you have to be really careful of. It can make them great businesses as well, because often people get paid the cash up front to provide a license fee to provide a service over a year, and they've already developed the software. It's a really good model. But if you're booking the revenue but not yet receiving the cash, it's very obvious. If I've shipped a product out of my warehouse to a customer on a certain date, it's obvious that I'm recognizing revenue. It's less obvious with this sort of thing. The other one is outsourcing companies. So I think Carillion's the one that comes to mind.
Yeah, I was going to say, we don't recommend stocks on this podcast, but we do recommend books. And Tim Steer's The Signs Were There is one that I would recommend. That's very good on this issue of revenue recognition. It's a little bit out of date because they've now changed the rules. I don't think you would be able to do what Carillion did. But when you've got these long-term contracts over a year, that is open to abuse, I think. And they've now shut that door, but obviously haven't shut it particularly well.
Another one that comes to mind is I did spot in advance. And again, I'm not saying that anybody did anything wrong here, is a company called Techmar that provides cable protections and things like that to wind farms. You could just see that their receivables were increasing and increasing, and it was sucking in cash. So they were reporting these sales. I'm sure they were doing it all correctly. I'm not making any kind of accusation against the company, but the share price when I first looked at them was about 70p, and it's now maybe 12p, and they're doing fundraise with a strategic investor that according to their statements is going to be around 9p. So there's a kind of 30% dilution at 9p, and it seems that they're just struggling to get paid, and that puts a lot of strain on a company. So even if there's no accusation of wrongdoing or anything like that, kind of companies where the receivables are stacking up and you're looking at half a year to get paid on average, potentially a weak business, even if everything's above board and everybody's doing everything correctly, still can be just a very bad business model.
Absolutely. So should we wrap up there?
Yeah, I think that's hopefully enough warnings for people on these things. Hopefully, yeah.
We'll be back in a few weeks' time with another podcast.
Thanks for joining us on the Value Trap podcast. If you like what you heard, do remember to subscribe and leave us a review. And we'll see you in a couple of weeks for our next episode.